All right, let's talk about something that's been on people's minds for, just a few thousand years. Gold and silver. We're going to dive into what it really means to invest in precious metals today. So here's the big question, right? Is gold a brilliant move for your money, or is it basically just an ancient relic? I mean, do you really need to be buying giant gold bars like you see in the movies? Let's get into it and figure out what's real and what's just hype.
For literally millennia, people have valued this stuff. Civilizations have used it as money, worn it to show off their power. I mean, they've fought wars over it. That long, long history is a huge part of its appeal. But how does that actually help us as modern investors?
Okay, this is probably the most important thing to understand right from the start. Gold is fundamentally different from other things you invest in. A stock, that's a tiny piece of a real company that's out there making stuff and hopefully making a profit. A bond, that's basically a loan where you get paid interest. But gold, well, it just sits there. It doesn't do anything. So you got to ask, what's the point?
And the answer to that question is really all about defense. The best arguments for owning precious metals aren't about getting rich quick. It's about security. So think of it less like a sword you'd use to attack the market, and more like a shield to protect everything you've already built.
The whole case for gold really boils down to these three jobs. People see it as a hedge against inflation, a safe haven for when things get crazy, and a really useful tool for diversification. Let's break down what each of those actually means for you.
First up, inflation. And you've definitely felt this. It's that annoying thing that makes a gallon of milk or a tank of gas cost way more today than it did a few years back. Your money just buys less. The idea here is that while the value of your cash is going down, the price of a rare, physical thing like gold tends to go up, which helps your savings keep their real value.
Next is this safe haven idea. History shows that when the stock market panics and investors get scared, they often run for cover. And for centuries, gold has been seen as that safe place. I mean, look no further than the 2008 financial crisis. As stock prices were just collapsing, tons of money flowed into gold, and its price went through the roof. And this leads us to what might be the most powerful reason of all: diversification. Just picture your investments like a seesaw. On one side, you have your stocks. They can go way, way up, which is awesome, but they can also come crashing down. Now, by putting some gold on the other side, you add balance. Because often, when stocks are falling, gold is rising. It smooths out the whole ride, making it a lot less stomach-churning.
Okay, so gold sounds like this perfect defensive asset, right? Well, not so fast. On the other side of the coin, pun intended, there are some very real and pretty significant downsides you need to know about. And here it is, the biggest pitfall of all. A bar of gold sitting in a vault creates zero new wealth. It pays you no dividends like a stock does, and it pays you no interest like a savings account. The only way you make money is if you can sell it to someone else for a higher price than you paid for it. That's it.
And it's not just that lack of income. You've got all these other hidden costs, too. If you buy physical gold, well, you have to pay to store it somewhere safe and get it insured. The price itself can be incredibly volatile, especially for silver. When you buy physical coins, you'll always pay a markup over the spot price. And sadly, the whole industry is kind of known for scams targeting new investors. And then on top of all of that, there's taxes.
Yeah, this is a little detail that trips up so many people. In the United States, the IRS doesn't see gold bullion as a regular investment. Nope, it's taxed as a collectible. What does that mean? It means your profits could be taxed at a rate as high as 28%. That's way more than the 15 or 20% most people pay on their stock market gains. That's a big deal.
All right, so we've gone through the why and the why not. But let's talk about the how. If you do decide this is right for you, what are your actual options? It pretty much comes down to a choice between holding the physical metal yourself or buying what's often called paper metal.
So when it comes to actually buying the stuff, you've got a few very different paths you can take. You can go old school and buy actual physical coins and bars, or you can buy something on the stock market that just tracks the price. Let's look at the main ways to do it.
You've basically got three main options. Number one, physical bullion. We're talking actual coins and bars you can hold. The huge pro is that you truly own it. It's totally separate from the banking system. The cons, well, you have to store it, insure it, and it can be a little harder to sell quickly. Option two is an ETF, an exchange-traded fund. This is super easy. You buy and sell it just like a stock. Fees are low, but, and this is a big but for some people, you don't actually own the physical metal. And option three is buying stocks in mining companies. The upside is you could get much bigger gains. The downside is you're not actually owning gold, you're owning a company, with all the risks that come with it.
So, for a beginner, what's the bottom line here? Look, for most people who are just looking for that simple diversification, that seesaw effect we talked about, a low-cost gold or silver ETF is by far the easiest, cheapest, and most straightforward way to get started. All right, we've covered the pros, the cons, the how-tos. Let's pull all this together and come to a final verdict. What is the right way to think about precious metals in a modern investment portfolio? And we're back to the biggest question of all. Should you buy it? And the real answer is, it totally depends. It really depends on where you are in your own financial journey. And I can tell you this for sure, it is not a step one investment.
I want you to think about your finances like this pyramid. Before you even think about buying a single ounce of gold, you have to build a solid base. That means having a 3 to 6 month emergency fund in cash. Done? Okay, step 2. Pay off all your high-interest debt, like credit card debt. After that, step 3 is you start investing for real growth in things like a Roth IRA or broad market index funds. Only then, once all of that is solid, way up at the very top of the pyramid, should you even begin to consider adding alternatives like precious metals.
And even when you get to that stage, almost every financial planner will tell you to keep it as a pretty small slice of your overall pie. A very common guideline is to put maybe 5 to 10% of your portfolio in precious metals, with the other 90 to 95% working hard for you in your main growth investments.
So if there's one thing to take away from all this, it's this analogy. Precious metals aren't good or bad. They're a specific tool for a specific job. Think of your entire portfolio like a car. Your stocks and other growth assets, that's the engine. That's what creates the power that moves you forward toward your goals. Your gold, that's the airbags. It's not going to make the car go any faster, but if you ever get into a serious crash, you will be incredibly glad it's there.